Alright, let's kick off the last week's earnings breakdown with Broadcom, ticker symbol AVGO, one of my top holdings. I own 111 shares at an average cost of $180 and I'm sitting on a solid 36% gain. That's roughly $7,000 in profit. But after the recent earnings report and a dip in the stock price, is it time to trim, hold, or double down? My stock prediction model still sees 19% upside for Broadcom this year and a staggering 139% upside in the next 5 years. That's why, despite the dip, I remain bullish. Let's unpack the numbers. Broadcom reported $15 billion in revenue, up 20% year over year, a strong print that matched analyst expectations. Adjusted earnings per share came in at $1.58, beating estimates by just a penny. Not a blowout, but still a win. But the real star is AI revenue. It surged to $4.4 billion. That's a 46% increase compared to last year. And get this, next quarter, they expect AI revenue to climb to $5.1 billion. If that happens, it'll mark 10 consecutive quarters of AI growth. That's not luck, that's momentum. Research firms like Milius are calling Broadcom a must own AI stock, and it's easy to see why. Their networking and switching businesses, which powers AI chip clusters in data centers, now accounts for 30% of their total AI revenue. That's a deep competitive moat, and not every chip maker has that advantage. CEO Hawk Tan's integration of VMware is also starting to show results. It's boosting software margins, locking in stocky enterprise clients, and improving recurring revenue. As he put it, cash flow is king. And Broadcom is proving that every quarter. Now, despite all this good news, the stock fell more than 8% after earnings. Well, and the reason is it's been on a tear, up 78% since April lows. Sometimes Wall Street just needs a breather. That doesn't change the fundamentals, it just resets short term expectations. One interesting tidbit from the earnings call was they are in talks with four major clients about custom silicon. Analysts are speculating those names could include Google. If those deals materialize, we could see another breakout leg. To me, this is a classic case of a high performing stock getting dinged by lofty expectations, not weak performance. I'm holding through this dip, and honestly, if it pulls back further into support levels, I may even add more. AI isn't just a buzzword here, it's a real revenue engine. Now, let's talk Lululemon, ticker symbol LULU, where the post earnings reactions was a lot more dramatic. Shares plunged 22% after earnings. Let's break down what happened. Revenue for the quarter was $2.37 billion, just a hair above estimates. EPS was $2.60, and again, they barely beat. But the US growth slowed to just 2%, and same store sales missed again, signaling customer caution. The big problem was they cut full year EPS guidance to a range of $14.58 to $14.78, down from earlier projections. CEO Calvin McDonald pointed to tariff uncertainty, saying shoppers are hitting pause to see if prices jump. And that's a real risk. 40% of Lulu's goods come from Vietnam, which could get hit by a 46% retaliatory tariff if trade tensions flare up again. They highlighted strength in new lines like Glow Up and Daydrift, but analysts remain cautious. Raymond James said it's unclear if innovation is actually driving traffic. Jeffries was even more blunt, saying there's no more juice in the lemon. That's a strong statement. Lulu's Q2 forecast also came in soft. They're expecting their revenue to be $2.53 billion to $2.56 billion, which is just at consensus. And the EPS is 2.85 to 2.90, way below the $3.29 analysts expected. Right now, I'm neutral. I don't own Lulu yet, but if the stock holds around $300, I'll watch closely for signs of stabilization. If tariffs escalate or sentiment worsens, we could see a deeper pullback, maybe to $220. And if you like this company, That's where you can consider adding a small position, but only if the next earning calls shows some turnaround. Lastly, DocuSign. Great numbers, but the stock still crashed. Let's dig in what happened. EPS came in at 90 cents, beat by 9 cents. Revenue was $763 million, beating expectations too. Even added $1 billion to their buyback program, which should be bullish. Subscription revenue grew by 8% year over year. Margins stayed strong at over 82%, and billings were up 4%. All good signs, but the stock fell nearly 15% after hours. This looks like a classic sell the news movement. The stock ran up before earnings, and while results were solid, growth remains modest. Investors were most likely hoping for something more exciting. I don't hold Docu yet, but it's been on my watch list. If it holds above $75, I may consider a small position. If it drops below $70, I'll wait. I want to see better growth visibility or a stronger catalyst. All right, to recap what we just discussed, Broadcom, I'm still bullish and may even add more. Lulu, I'll be watching but not buying yet. Docu, it's an interesting setup, but I need a stronger signal. If you found this breakdown helpful, subscribe to Mindful Investing for real portfolio updates, in-depth stock predictions, market level insights, and thoughtful investing strategies. Drop a comment below. Are you buying the Broadcom dip? Is Lulu a value play or a value trap? Would you buy DocuSign on this drop? Let's talk investing together. And finally, if you want to watch my full portfolio breakdown, link is in the description. Please watch it. Thanks for watching, and I'll see you in the next video.